Jill, thanks for meeting with me again. It was great getting to know you a little bit on our introductory cash consultation call, as we call it. But at this time, I think your goals are to set your children up kind of for the long-term success of infinite banking. And that's what we do, crack the code to cash flow over here. So before we start, why don't you give me a little bit of your background again and your parameters of what you're trying to think. Just don't worry about the math and the numbers. I'll handle that stuff. But tell me about yourself and your business again so I can understand how we can position the right types of construction or kind of a manipulation, you might say, but engineering of policies for cash value. So tell me about your business and tell me a little bit about your family.
Perfect. Thank you for meeting with me again. And you're right. I am wanting to learn more about setting up policies for my two daughters. We talked more about how I can leverage life insurance policies I am an investor and I run a fund for people who want to make large returns on investing in multifamily real estate or mobile home parks. And as my cash flow comes in or my real estate deals, I'm trying to find an approach of where I can place some of my money where I can set up my daughters for success long-term game. So being able to put them in a policy, and when they become of age, I know there's ways you can set it up for either college or if they want to take a loan for themselves, learning how to basically set some of my money aside to, of course, I want to find ways to help my kids. We always want things better than we might have had them. So thinking far enough in advance and preparing now for the future for them.
Love it. Okay, well, that's what we're going to do. So I'm prepared for that. And I like to say a lot of times for our children and the next generation, we want to help them know more than we knew and do better because they have more opportunities and at least the know-how. So we can totally set that up. Crazy enough with whole life insurance, the kind of life insurance that's guaranteed to grow and cash flow, as we say. So the kids, this is what we all wish for our kids. I'm a father as well. Happy, healthy, and honorable, right? That's what we want for them. We want them to do well and be happy in life. And we can do that, crazy enough, by the dollars that we make today, we can keep in the family. We don't have to let them go to third-party costs. We don't have to lose the interest on those dollars. Every dollar that comes in, we should actually be able to keep, and those dollars should work for us forever. Well, there's one thing that people need to understand well, and that's what we educate here on at the Cash Compound. One thing, and if they add this one thing into their family's financial life, there's going to be a free future for them. So let's jump into that right now with a 3-cup setup. I've got it here on the table, but I'm going to show it to you on the screen as well so you can see what's going on and how whole life insurance is actually that vehicle and that tool that if we understand what's going on, how to use it, we're going to get it to exactly where we want to go. Okay, so can you see that on my screen there, the 3-cup setup?
Yep, I see them.
Wonderful. Okay, so cup 1, the red cup, is where we place our dollars. Most of the time, we make money, and you and me and several of our colleagues were pretty good at making money, but maybe we're not so good at keeping it in our family forever. That's what we're going to talk about here. So the red cup is the dollars we give the insurance company. And if we give them money, it's called premium. And Jill, what does it buy in life insurance? We can give them premium for car insurance and phone insurance and fire insurance for our homes. But if we give them premium for life insurance, not a trick question, what does it buy?
Life insurance.
There you go. Death benefit, right? The life insurance, the policy, the payout, the peace of mind, right? Pool of funds. That's going to be over here in cup number 3. So we give them dollars, they'll pay out a big, much, much bigger amount. Obviously, this is not drawn to scale. And in life insurance, there's a huge difference between phone, fire, car insurance, and that there must be a payout one day. We're going to die. So we're going to buy whole life insurance. It's the only kind of insurance that's guaranteed to pay out. We have to die. There's no getting out of here alive. So cash value is the equity portion, the liquid portion How much of the total death benefit is paid up, paid off, or paid for? The insurance company is on the risk for everything. The Blue Cup, starting from day one, they must pay it out even if you died tomorrow or your children, God forbid, died tomorrow or they die when they're 105 years old. They have to pay out the Blue Cup, and cash value is the equity portion of that total that is liquid. There's some contractual rights that we have as the owner of this policy to be able to get to it. Are you with me so far?
Yes.
Cool.
Makes
All right, cool. So let's review these cups real quick. The red cup is guaranteed. The blue cup is guaranteed to grow. The green cup is guaranteed to cash flow. Okay? Guaranteed to grow and cash flow, to make it rhyme and easy to remember. The dollars that we give the insurance company never go down or backward. This is not an investment, Jill. This is insurance. So that means it's guaranteed to grow, to buy us a big pool of their funds that's on standby when someone passes away. Your beneficiaries are going to get this, by the way, income tax free. It's a big deal for legacy building. No new taxes. Read my lips. Okay. And cash value is the cash flow. It's how much of this pool we can get to, we can borrow against. It's the insurance company's money. We gave them our money that we worked hard for in the red cup. And cash value is the portion of their money, the blue, that we can get to. All right, so we're going to be able to take loans and borrow against our value, collateralize our policy, borrow against it, which is going to lower the death benefit temporarily, because that's why we can get to it. No questions asked, no credit check, no extensive paperwork, no business plan, an unrestricted loan, because they owe us death benefit. So the death benefit is going to drop while those dollars are out. We have the ability to pay for college, let's say, right? That's important. Education is important for many families. So even if our kids follow in our footsteps and become entrepreneurs, they can go get a business started. But if they decide to go to college and that's their dream out there, and they don't get lots of scholarships for playing ball or something like that, we're able to utilize these funds and have an unrestricted, on your own time, payback schedule. And even if we didn't, the death benefit covers it. Let's say, God forbid, they pass away before recovering all those loans. Well, the death benefit is always a bigger number. So loan repayments can go back in over time. It replenishes the death benefit back to normal. But notice, Jill, that our dollars that kept the policy secure never went anywhere. They're still there. They're still actually compounding. That's one of the guarantees. These dollars are still securing our policy and still giving us more and more cash value, even while we had loans out. Big, big deal there. Also, the premiums are level. So many folks out there are being shown or conned into or not understanding. There are multiple styles of life insurance, and whole life insurance has level premiums. It's also one of the guarantees. Therefore, premium doesn't change, doesn't get higher, doesn't go up. Whatever you picked as the deposit you'd like to put into this system consistently, maybe it's every month, maybe it's every year, doesn't change. Doesn't matter if our health goes bad, doesn't matter if our kids actually grow up and get ugly. Whatever, it's going to be the same premium. Okay, so loan interest. Once we recover the loans that we borrowed, we make sure folks understand that when we pay ourselves back with interest and treat this system like a bank, loans go out of banks and they come back with interest. The interest goes here. That's our money, our new funds for our banking system. So whatever interest you might charge yourself would go in cup one, buying more death benefit. That's what premium does. It buys insurance, and then the cash value rises. There's more equity. Now we can go back to college, whatever we want to do for our next cash value loan opportunity or investment or whatever our children are going to be doing. Also, Jill, at the Cash Compound, we only use mutual insurance companies for this process. Mutual insurance companies are different from stock companies. Do you know the difference by any chance?
You're going to tell me.
Oh, yeah, that's what I'm here for. Very good. Just love audience participation. So mutual insurance companies don't have stockholders. So dividends or profits annually from the company don't have any shareholders or traditional owners to go to. They go to the policy owners. Jill, who owns this policy?
Great.
That's right. So that you are a partner with the company. Insurance companies are very good at making profits. They take in a lot more premium than needs to be paid out on any given year. So they're going to allow you to participate in those profits, and it's basically like a bonus. You can elect for those dividends to go several different ways. One of those ways is they can send a check to your house. I don't prefer that method because I'd spend the money. So we're going to tell them, put the money on top of my money. I like money with my money, so why don't you drop those dividends on top of my premiums here each and every year that there are profits, which buys more death benefit in Cup 3 and cash flows more cash value for us and our families. Each and every year, dividends go up and get bigger as well because your portion of dividends, Jill, is going to be based on your contribution to the company so far. And each year, as you pay premium, there's more contribution you're giving them. Therefore, each year, they're going to owe you more dividends if and when they have profits. Now, dividends are extra and non-guaranteed, but all the companies that we broker with have paid dividends every single year without missing for at least 100 consecutive. So I think we can count on it next year. We're talking about coronavirus, World War I, II, III, January 6th, Yo Mama, Obama, recession, depression. They've paid every year. Sounds good?
I like it.
Okay,
yeah,
very
I like
good.
It.
Okay, so that's kind of what's going on here with our 3-cup setup. Remember, every dollar that we give the life insurance company and the whole life insurance policy that we bought, built on purpose by us for cash value, immediate use, every dollar is going to grow and cash flow for the rest of you or your child's whole life. It doesn't stop, doesn't slow down, and that constant compounding continues even while we take loans out for space camp, for a new bike, or for college. Our dollars are going to be uninterrupted. Does that make sense?
Yes.
Wonderful. Okay, so why don't we kind of have you jump in and just give me 1 or 2 details about your daughters here, and then I'll work up a little something for you that is going to make sense for an example illustration. Tell us about your family.
Perfect. I have 2 daughters. One is 5 and the other is 9. And they're in good health and trying to determine on how much to put in. I kind of have an idea on annually how much to put in. So I was thinking around $5,000 a year.
Perfect.
For each.
Okay.
If you're able to work up something
sure.
like that.
Yes. Perfect. So we had talked about those numbers. I did work up something for you so we can show you what's going on. So a reminder that you mentioned that, hey, I may not need to leverage this immediately. But remember that cash value in the types of policies that we build for folks over here does have immediate leveraging power. And Jill, when I do say immediate, I mean within 30 days. So in the event you wanted to get to the cash value that's there, it'll be on the paperwork, it'll be liquid. You can get to it as early as you like. But one of the examples that I worked up for your younger daughter is we're going to be able to kind of test the waters of what if we actually waited until she's in college? And what would it look like at that point? Because maybe you're out there hustling and doing all your good work. You don't need to utilize this policy right away. Just wanted to remind you that it is available for you to be using cash from it and banking with it as early as you like. Okay?
It'll still grow even if I don't leverage it, though.
Of course, yes. Every dollar you put in premium is going to continue to compound, giving us more death benefit. That's another thing I should say. These types of policies we're talking about, there will be a rising Cup 3 or death benefit for the rest of their life. It'll be going up. Therefore, there's going to be more cash value in the Green Cup as well. So those are the pools of the insurance company's money separate from our premium Red Cup that you guys can get to. Yeah, 100%. All right. So let's take a look at that right now. Jill, what we've got here is an illustration, not a contract, but it's going to be able to show us the numbers. If and when your daughter is approved for this insurance, at what we can do with this cash value and kind of how it works. So I'm going to explain things in terms of the 3-cup setup again for your 9-year-old. So if we scroll down here to this particular page, what we have got is an insurance policy that is going to be paid up at your daughter's age 65. That means at that point, you don't have to contribute any more into premium or the red cup. But the policy, of course, will continue to grow and cash flow until your daughter's eventual demise. We hope that's way down the road and, of course, way after you, but no more premiums are required, even though the policy is still active and is still growing cash value for, I assume, her at that time. Does that make sense? Cool. Okay. So as you can see up here, we've got 9-year-old daughter, and we have an initial death benefit with a $5,000 annual premium. Okay. Children are rated in their health category automatically as standard non-tobacco, and they have the ability in most cases at age 18 when they become adults to go get a better health rating at that time and potentially get a little more cushion and bump up in the numbers. But insurance companies automatically rate them at standard as opposed to preferred or select at the outset. Okay? Just trying to be thorough here for you. So as we take a look at this, I want to help you understand just a few things here. It's not supposed to be super technical, but it is going to help you understand what's going on. Down this page, in this tabular details here, what we're looking at is time as we move down the page. The first 2 columns are time, and the third column is the red cup, the money that you plan to contribute to the insurance company on your daughter's behalf, and they're going to make the dollars work for us. Those are all of the other numbers on this page. Many, many columns, many, many numbers, but we need to know what's happening before we try to do math or something like that. So that's cup 1, column 3. You can see that it's a $5,000 contribution here. And then I'm going to skip over to cup 3. Remember, premium buys insurance. Cup 3 is the blue cup, and that's death benefit. Do you see that column there?
Yes.
Okay. Generally speaking, what do you notice about the numbers in that column as time moves down? What's happening?
They're just growing.
They're getting bigger. Very good. Okay. Great. And then the middle 2 columns in between that, at this particular company, a mutual insurance company that's been in business for over 145 years and have paid dividends every single year. I have 5 policies myself from this company. You can see cash value. That's the green cup. And in this particular cumulative example, we are going to have to add both of these columns together for the total cumulative cash value that you and your daughter can use, lose, or abuse, whatever you want to do. Okay? So you can see that here. In year 1, Jill, we can see that we have $1,940 available of the $522,000 that you and your daughter could get to for whatever great idea she has. Lemonade stands or summer camp. Whatever it is, doesn't matter. You're going to be the owner of this policy. She is the insured, and there's also a beneficiary. Now, I'm assuming that you plan to be the beneficiary. God forbid she passes away while she's in the house, right?
Yes.
Okay, so you're the owner and the beneficiary. You can't be the insured. Of course, the insured cannot change. It's going to be on her for the rest of her whole life, but the owner and the beneficiary can change. This is a private asset for the Jensen family. If you'd like to gift it to her or sell it to her when she is of age, you can do that. It's a private asset. Okay? If you would like to put me as the beneficiary, no problem. I'm in. Okay? Whatever you want to do. All right? All right. So what we've got here is a simple way to understand what's going on. Can you tell me, generally speaking, of course, it's not a trick question, what do you notice about the trend of cash value in these 2 columns as time goes by?
It's just continuing to grow.
There we go. Every dollar we put in, cup 1 or contract premium column, is compounding. It buys us something, and here's the liquid numbers that we can use of that pool over the course of time. You're contractually able to get to that money for any reason, no questions asked. There's two questions they'll ask, Jill. I'll be honest. One is, do you trust USPS if we send you a check? Or would you like it direct deposit? Those are the two questions.
Okay.
That's it. All right. No hassle. And you and I are types of people who've gone into the bank once or twice, traditional, conventional bank on the corner. We've asked for big numbers, and they asked us questions about our own money.
Mm-hmm.
That's I feel offended. It's only happened to me a couple of times, but they don't ask that at the insurance company. They owe you the death benefit. They don't ask questions. They just ask you where should they send the dollars.
Perfect.
Okay, yes, ma'am. So as you can see, as we move down in time, things are getting better and better and better. Now you'll notice in year 9 of this policy, when your daughter's 18, I have changed and dropped off some of what's called the PUA, paid up additions, this word right here, and I've gone down to the base premium. That's because the policy is running more and more efficiently. As you can see from this column, without being too technical, this first column of cash value is over time growing at a better clip than the PUA cash value.
Mm-hmm.
So we're going to be able to utilize the base premiums growth in this cash value column as more efficient over time. But in the PUA cash value column, you can see it starts earlier and starts better, but it doesn't work as efficiently over time. That's some technical things, but the reason I bring it up, one is so you know what you're looking at, and two is so you understand that the construction and engineering of the policy is important. This is not something you can buy over the shelf, Jill. We do this specifically, and we're a boutique shop that knows how to design policies for the use of the owner for cash. That's very important. Okay. So just wanted to point that out to you. But you'll also notice that the premium over the course of her life is never getting higher, is not going up. You are contractually able to give them the same amount of money and potentially less money, and you're still going to see ever-increasing compounding growth on the dollars they give you. Do you have any problem with being able to give someone the same amount of money, no matter what taxes do, no matter what inflation does, no matter what time does, and they, while you give them the same amount, they have to give you more? Is there any problem? I didn't think so. Perfect. Okay.
No.
So, yes. Okay. So that's kind of what's going on here. I want to draw your attention to the top of the columns. You can see guaranteed. The left side of this page shows you the guaranteed numbers. I did not put that there. The insurance company did. So these are net cash dollars.
Okay.
We are not worried about commissions and fees or taxes. This is net cash, and it's guaranteed to go up. Very important to understand. We can park our money a lot of places, and I firmly believe that most of us don't realize that we're parking our money in places all the time that's not guaranteed to go up. There's taxes, fees, or issues because all we can do is withdraw them rather than borrow against them. And we have no idea how maybe commissions or something like that works. So true or false, do you know people, maybe you're not one of them, but do you have lots of friends out there who do deals with you and invest with you who are still potentially participating in qualified plans? There's a lot of different types, but do you know some people like that?
Yes.
Now, qualified plans are market-based. Yes, up, down, left, right. We have no idea how they're going to be earning or losing, correct?
Right. That's why I'm interested in continuous growth and secure. You only know it's going one direction.
Yep, that's what we have here. It's going up no matter what, and it's guaranteed in the paperwork. But if we're participating in some of our investments out there, we don't know either. We speculate or we get really good at understanding what we're investing in, but it's not a guarantee that it's rising, right? And of course, in a 401k or something like that, we don't control that. They go down all the time. We're afraid to look at that quarterly statement. And Jill, there's still going to be commission. What you're looking at, even if you've got this idea of average in the market, that doesn't mean that taxes and commissions are taken out of that number. And sometimes it goes down and your fund manager still gets paid.
Okay.
All right. So we're just trying to make sure we understand the differences between that and constant compounding and leveraging power without losing your growth in whole life insurance. On the right side, we're going to see non-guaranteed. This is where the dividends are purchasing paid up additions. In these types of policies, we're going to be able to get that little shot glass cup also from the insurance company. And you can see that the guaranteed cash in the first year of this policy, built for cash down the road, we're going to use it. I'm going to show you your other daughters, maybe going to college here in a second. $5,000 in, an immediate cash value of $19.40. But in the event that the company pays out their dividend at this rate in the first year, you can see $19.40 is actually $19.59. They assume they're going to be paying dividends since they've never missed. And if they pay it at this level, they're actually going to give you more dollars, which gives you higher cash over time and growing death benefits still. Questions, concerns about any of what you've seen so far?
No, this looks great.
Wonderful. Okay, so I want to tell you about banking really quickly in this one, and then we'll look at your other daughters, and we'll actually take some loans out of that one. We'll borrow against that policy, and what we'll be able to do is see how it works over the course of her lifetime. But remember, you're an investor. I know that you're into funds, and we look forward to sending people your way who come through this portal, and we'll do some deals with you as well. But if you took out $2,000, let's say, from this policy and you put it into an investment. Remember, we're borrowing from Cup 2. When we borrow from things, we plan to pay it back with interest, and the interest would go on top of our premium in Cup 1. So, Jill, if you do a deal, an investment for $2,000 or so from this policy very early on, I'm assuming you want a return, right?
Correct.
Cool. So let's come up with a return. So if you invest with someone out there, I know we're both friends with Pace Morby out there in the sub-2 world and some other creatives in real estate. If you give them $2,000, what do you expect in return?
Probably a 15%.
15%. Okay. So I'm going to do some quick live math here. So 15% of 2,000 is going to be $300. $300. Love it. Thank you for saving me. So you borrow $2,000 from your own policy or your daughter's. You plan to get a return of all of that money plus $300 of someone else's. Is that correct?
Yes.
So we're going to replenish the cash value, which is the insurance company's money. Remember, death benefit and cash value, that's their money. We bought it. And the $300 goes on top of your premium contribution. So, Jill, what's going to happen if you, instead of putting $5,000 inside this policy, if you put $5,300 because someone gave you a return, what's going to happen to every single number on this sheet for the rest of your daughter's entire life?
It will be higher.
It's going to have to grow. You got it. That $300 will stay with her for her entire life and keep working for her. Jill, Nelson Nash said it best. He is the author of The Infinite Banking Concept, the developer of the book, The Whole Experience. He said that he reminds us that when we're financing something, we're spending money on something, we're always financing it. There's only two ways to finance something or spend money. One, we lose our money by paying cash. That's how I always did it until I learned this. Or we borrow someone else's. There's only two ways. So we finance everything we buy. We pay someone else interest, or we give up the interest we could have earned because we used our money. In this system, we retain the control. We never lose any of it. That's what's beautiful and powerful. Okay, Jill, so what we've got here is an illustration example that's going to show off something a little bit different. Not just the accumulation of funds. We didn't go into all the great numbers, but we saw that they were always rising on your 9-year-old. But on your 5-year-old, what we constructed here is utilizing this policy for some big expenses. We're going to finance things or borrow from Cup number 2 while our money, Cup number 1, keeps compounding. And we're going to see kind of how that works in this quickie example. So you can be prepared for a future expense, because your goal on your daughter's policy is not to go invest in real estate or in funds right away. We're going to have this for her. We're going to push it down the road for her to be able to use for something like college. Does that sound good?
That sounds great.
Okay. Well, let's take a look. So once again, we have got a policy that is paid up at 65 years old, meaning that it continues to grow and cash flow, but at the time she turns 65, it no longer requires premiums. $5,000 per year. Buys us a death benefit today, Cup 3, Blue Cup, but it also kicks off immediate cash value that's very similar to your older daughter's right away. Now, we don't plan to use it, once again, but you can see that this is Cup 1, Red Cup. We've got Cup 3, Death Benefit, and we've got Cup 2, Green Cup right here. Does that all make sense so far?
Yes.
Okay. We also, in this column on this particular example, show the projected non-guaranteed dividend that the company thinks they'll be paying based on today's dividend scale numbers. This is what they think they'd be paying if you never gave them any more money than the contracted premium. Okay. Now, we plan to potentially give them premium, PUA premium or loan interest, but if we never did that, this is what they think they'd be paying out each and every year on top of your money to make the numbers grow bigger in the cash value and death benefit columns. Does that make sense?
Yes.
Cool. All right. So you can see that we've got time going down the left side here. So what I did is I constructed this example of your daughter's policy of what you can see is we've got time going down the left side, and in this example of your daughter's policy, we're going to be putting in $5,000 until she's 18 years old. That's about 13 years, right? You said she was 5.
Mm-hmm.
And at that point, we might change up our approach a little bit because she's off to school, whatever she plans to do. Maybe she actually just starts a business at that point. We don't know, but I'm going to show you what happens because we can utilize this policy for cash at that point. Maybe it's something she wants to do. And so what we are showing here is we have got a total cash value at this point when she is 18 years old of $64,000 plus. You can see that here in this line. $64,000 plus that is able to be used, loosed, or abused for whatever she wants to do. And what I did at this point is we started to pull loans at that point. 13 years of mom contributing $5,000 into your 5-year-old's future. By the time she turns 18, she has a wild and crazy idea, probably exactly what you're prepping her for, Jill, and that's to go into business with you. How's that sound?
That's why we're here.
Wonderful. Okay, so she might go to college, but I don't know. We might teach our kids to get into business with us, even if they're continuing their education. So in this particular example, what we're seeing, starting in the 14th year of the policy, she's 19 years old. She's going to take an $8,000 loan from Cup 2 against her policy. Her death benefit is the collateral, plenty of that. They don't ask her any questions. And as you can see at that point, what's really important to understand is she has got a liquid pool of money she can get to for investments with mom at $60,000 plus. That's why they don't ask her any questions about getting to that $8,000. Does that make sense?
Mm-hmm.
Okay. Now, she is borrowing from her policy. There's only 2 ways to finance purchases or to get into investments. It's 1, spend your money and you lose the interest, or 2, borrow from a third party and pay the interest. So in this particular example on this particular company's paperwork, we can see that the $8,000 loan also is accruing interest of near $500 for that year. Can we see that?
Yeah.
Okay, cool. But it's no problem. She's got $60,000 plus to be able to go into business with you. And in this particular scenario, I'm going to say business because that's what you and I like to do and what we're teaching our kids. But we're going to take $8,000 for 4 years. So maybe for some other family out there, it's a great community college close to home. 4 years of $8,000. So we can see the interest accruing. Do you see that? More borrowing, more loan interest each year.
Okay.
That's what we've got going on. Okay. The premium has actually changed to $3,000 because mom decided, let's say, to kind of go down to the base premium, $3,000. We saw that on your daughters because mom decided to go down to $3,000, just like we did on the older daughters policy. So that's why this number is -5, because we're still putting in 3, but we took out 8. So that's the -5 number. It's neither here nor there, but I don't want people to be confused or yourself. That's what's going on here. You are contributing $3,000 still, or maybe she's now got a job and she's contributing $3,000, but she borrowed 8. That's why this number reads -5. Does that make sense?
Yeah.
Okay, cool. That's what's going on. And you can see after her 4 years of $8,000 loans against her policy, you can see that's why these $3,000 are still here. That was still going in throughout the use of this $8,000 each and every year. Okay, what's important to remember is that there's no, this is an unrestricted loan. There is no payback she must do. Now, I'm assuming if she's in business with you, she's expecting a return. I know you're into like multifamily and like RV parks and things like that, right? Mobile homes?
Mm-hmm.
Yes. Okay. So we're going to get that return. But in this particular scenario, she goes 4 years of $8,000 and then 3 years of no payback at all. So she's taken money from her policy, borrowed the insurance company's cash value for her. She's never paid a dime back. She stops taking loans for 3 years in age 23, 24, 25. She's putting in $3,000, but she's still not paying it back. But she decides, well, when the ship comes in, okay, you guys flip some properties or you sell off some stuff, she actually starts to pay it back at $10,150 per year. Now, the reason this number is $13,150 is because remember, we're still contributing the base premium of $3,000. So it's the $10,000 of loan repayment back to her policy plus the $3,000 for a total of $13,150. Does that make sense?
Yes.
Wonderful. And as you can see, her cash value is still growing. It's back. Mm-hmm. All the money is here. So we never lost control of the money. It was never invested. It was never going backward. We were never losing it. We've replenished our policy right here. And as you can see, over the course of that type of payment schedule that was completely made up by her or you, whoever is putting money back into this policy, we have no loan balance. We're back to no loan balance at this time when she's about 30 years old. The policy is whole, and there is still a growing $123,000, $140,000 in this policy, getting bigger each and every year. Does this make sense?
Mm-hmm. Yes.
That's the power of this, but it continues for the rest of her whole life. So we can see that we've borrowed, we've replenished, we've put interest back on it. The policy is still growing. And then she decides that she is going to mutiny. She's not going to do business with you anymore, right? Once she gets to the point of about 34 years old, mom is losing it. She does things the old-fashioned way, and she needs to go out on her own, and she takes $50,000 from this policy as a cash value loan. You can see that she had over $167,000, and she pulls $50,000 of it at this point. Okay, and then she spends. She cash flows right away, starts paying it back, doesn't wait, but she starts paying back around $13,000 per year to pay it back. She learned everything she needed to learn from mom. She branched out on her own, and now she's able to replenish this policy with cash value loan repayments to Cup 2 plus interest to pay off that loan in her 38th year. You see how this is working?
Yes.
It's completely replenished. And so she pulls out 50. She puts back 13 for 4 years. She even paid herself some extra interest, and all that money is recaptured. And in her 39th year, she has got whatever cash flowing properties are going on out there. And she's got $233,000 inside her policy, free to use. Now, if you remember, if we go back up to that initial death benefit on this policy, when you first started it, back when she was 5, there was $595,000 or so in death benefit. At this point, she has used the policy throughout her adult years, her young adult years, to get into business with you, to go into business with a $50,000 purchase for herself, whatever it was. And the death benefit is over double at this point. And she has $233,000 of liquid cash for her next financial adventure. Whether it be a wedding or a house for herself, or she wants to give it to church, whatever it is you guys are into, it is liquid and it's ready for her to be used. No income taxes at all on utilizing that money, and it's completely unrestricted when she takes that loan. She can do whatever she wants with it. And as you can see, Jill, what is happening to those cash value numbers over the course of her life?
Rising. I'm 35 and I'm looking at that number and I'm like, $246,000 at my age.
Right.
If my parents had set this up, they could have put that much in there a year.
But education is the key. Nobody told them, right?
No, that's why I'm here learning from you.
There we go. So this is a powerful, powerful tool. So to kind of wrap things up here, I want to help you get started. That's what we do. We work off referrals and friends and family. We're helping people become cash flow code crackers by utilizing a guaranteed insurance product that always goes up, always rises, always has a separate pool of money that you can leverage for whatever reason, no questions asked, income tax free, and leaves a legacy for your family. This is the one tool that you need inside your family's arsenal to be able to finance anything. Because we're not losing money to third parties. It's all being captured in here. So we're going to help you get started and understand how you can continue to do this process throughout your whole life by teaming up with us and us giving you this free coaching. That's what it's all about, Jill. So I appreciate your time, and we're ready to go when you are. Sounds good?
That sounds great. And I appreciate knowing that you'll be here along the way, not just signing the policy up and saying good luck, but like if I have questions or meeting with me, that you'll be here to answer some of those questions. So I appreciate you taking the time to explain it and being able to help me through the process.
You're exactly right, and you are welcome. What we're here to do is help people with banking as a process. Banking is not just a place anymore. Banking is something that you do. So we do it as well. I've got policies on all my children. There's 4 of them. We're building policies for them just like this, so I'm here to help.
Great. Appreciate it. Thank you.
You are now tuned to the banking bro. Said we couldn't make it. 3 settle. This the life we chose. Gave a lot of game. We never got a lot of things. Bow your head and say the prayer. We taught you how to be the bank.